After years of anticipation, the U.S. Securities and Exchange Commission finally gave the green light to the first Ethereum exchange-traded funds, or ETFs, in late 2023. This landmark decision sent ripples of excitement through both Wall Street and the crypto community, marking a significant step towards mainstream acceptance for the world's second-largest cryptocurrency. For many, it signaled a coming of age for Ethereum, paving the way for a new wave of institutional investment and broader adoption. The approval of Ether ETFs was seen as a watershed moment, potentially bridging the gap between traditional finance and the often inscrutable world of cryptocurrencies. ETFs, familiar investment vehicles traded on regulated stock exchanges, offered a simplified way for investors to gain exposure to Ethereum without the complexities of owning and securing the underlying asset. This ease of access was projected to attract a surge of capital from institutional investors and individuals who were previously hesitant to navigate the intricacies of cryptocurrency exchanges. However, amidst the euphoria, a critical debate began to take shape, centered around the very essence of cryptocurrency's decentralization. While ETFs promised to democratize access to Ethereum, some argued that this convenience came at the cost of compromising the core principles that underpinned its creation. The stage was set for a clash of ideologies, pitting the allure of mainstream adoption against the potential risks to the decentralized ethos of the crypto world. The arrival of Ether ETFs was met with open arms by Wall Street institutions eager to capitalize on the growing interest in digital assets. For years, these institutions had largely remained on the sidelines, deterred by the regulatory uncertainty and volatility associated with cryptocurrencies. ETFs, with their regulated framework and ease of trading, offered a familiar and less daunting entry point. Major financial players, including Fidelity, BlackRock, and Goldman Sachs, quickly jumped on the bandwagon, filing applications to launch their own Ether ETFs. These institutions recognized the immense potential of Ethereum, not just as a speculative asset, but as a revolutionary technology with applications spanning decentralized finance, supply chain management, and digital identity. The prospect of offering their clients regulated exposure to this burgeoning ecosystem was undeniably attractive. The influx of institutional capital was expected to bring about a new era of stability and maturity to the Ethereum market. Increased liquidity and trading volume could potentially mitigate the extreme price swings that had come to characterize cryptocurrencies. Additionally, the involvement of established financial institutions was seen by some as a step towards legitimizing the asset class in the eyes of regulators and traditional investors. However, the embrace of Ether ETFs was not universally celebrated within the crypto community. A vocal contingent, particularly among early adopters and developers, raised concerns about the potential for centralization and its implications for the future of Ethereum. At the heart of their argument lay the fundamental principle that had underpinned the creation of Bitcoin and subsequently Ethereum, the decentralization of power. Cryptocurrencies were conceived as an alternative to traditional financial systems, which were seen as centralized, opaque, and vulnerable to manipulation. By distributing control among a network of computers, rather than a central authority, cryptocurrencies aim to create a more transparent, equitable, and censorship-resistant form of money and finance. Critics of Ether ETFs argued that by placing the control of a significant portion of Ethereum within the hands of a few large financial institutions, these ETFs risked undermining the very essence of decentralization. The fear was that these institutions, driven by their own profit motives and regulatory obligations, could potentially exert undue influence on the Ethereum network, jeopardizing its censorship resistance and open access nature. Section 4. The Dilemma: Accessibility versus Control. The debate surrounding Ether ETFs highlighted a fundamental tension within the crypto community: the balance between accessibility and control. On one hand, wider adoption and mainstream acceptance were seen as crucial for the long-term success and sustainability of cryptocurrencies. ETFs, with their potential to attract a broader investor base, offered a pathway to achieve this. On the other hand, the decentralized nature of cryptocurrencies was non-negotiable for many. It was this very characteristic that had drawn them to crypto in the first place, promising a break from traditional financial systems perceived as rigged and untrustworthy. allowing a handful of Wall Street giants to potentially control a significant portion of the Ethereum network, seemed antithetical to this vision. This dilemma was further compounded by the fact that Ethereum, unlike Bitcoin, was not just a digital currency, but a complex and evolving ecosystem. Ethereum's blockchain served as a platform for a myriad of decentralized applications and protocols, many of which were designed to operate autonomously and without the need for intermediaries. The question of whether the benefits of increased adoption through ETFs outweighed the potential risks to Ethereum's decentralized nature became a subject of intense debate. Section 5, a fork in the road charting the future of Ethereum. As the dust settled on the initial excitement surrounding Ether ETFs, it became clear that the debate over centralization versus accessibility was far from over. The crypto community found itself at a crossroads, grappling with the implications of this new era of mainstream interest and the potential trade-offs it might entail. Some argued that the influx of institutional capital and the regulatory clarity brought about by ETFs would ultimately strengthen Ethereum, paving the way for wider adoption and the development of more robust and innovative applications. They believed that the decentralized nature of the blockchain itself would serve as a safeguard against any single entity gaining undue control. Others, however, remained wary, emphasizing the need for continued vigilance and a commitment to the core principles of decentralization. They called for greater transparency from ETF providers, advocating for structures that minimize the potential for centralized control and ensured the open and permissionless nature of the Ethereum network. Section 6. Conclusion. Navigating the crossroads of innovation. The arrival of Ether ETFs marked a pivotal moment in the evolution of Ethereum and the broader cryptocurrency landscape. It signaled a growing convergence between traditional finance and the world of decentralized technologies, bringing with it both immense opportunities and complex challenges. The debate over centralization versus accessibility was a microcosm of a larger conversation about the future of finance and the role that cryptocurrencies would play in shaping it. As Ethereum continued to evolve, navigating these tensions and finding a sustainable balance between innovation and the preservation of its core values would be paramount. The ultimate impact of Ether ETFs on the crypto landscape remained to be seen. However, one thing was certain. The conversation they sparked about decentralization, regulation, and the future of finance was far from over. As the lines between traditional finance and the world of crypto continued to blur, the decisions made by developers, investors, and regulators would shape the trajectory of this transformative technology for years to come.